The Fed is flying blind. America's data blackout hook. America's economy is flying blind. For the first time in modern memory, the Federal Reserve is weighing its next steps without the government data that usually anchors every decision. No fresh jobs report, no clean inflation print, and only a patchwork of private proxies to stand in for the official scoreboard. When central bankers say they're driving in the fog, that's not a line for television. It's a clear warning about risk. Tonight, we're going to break down what this data blackout really means, why it's happening now, how it changes the path for interest rates, mortgages, and markets, and what to watch in the next 2 weeks as policymakers try to steer without headlights. We'll also map the ripple effects for businesses, workers, and households. And we'll end with Frostline's take on what the smartest play is when the economy goes dim. What changed, and why now? Shutdowns begin as politics but end as operations. A budget standoff can feel abstract until it flips off the switches inside the agencies that measure the economy. Those agencies are not just bureaucratic boxes. They're the sensors on the aircraft. Without them, the pilot doesn't know the altitude, the airspeed, or the weather up ahead. In normal times, the Federal Reserve's dashboard is crowded with gauges: non-farm payrolls, unemployment, average hourly earnings, consumer price inflation, producer prices, retail sales, personal incomes and outlays, core PCE, ISM surveys, housing starts and permits, and the revisions that clean up the noise and leave a truer signal. In a shutdown-driven data blackout, many of those gauges dim at once. A few may flicker. Some workers get recalled to publish legally required figures. A single series gets pushed out on a one-off basis. But the composite picture disappears. Markets don't just lose headlines. Policymakers lose validated facts. And when a system built on transparency loses its scoreboard, two things happen immediately. Uncertainty goes up, and overreactions get more likely. Flying blind. In plain English, central banks don't manage vibes. They manage trade-offs. Without official data, you're not simply missing a press release. You're missing the calibration tool that tells you whether the economy is running hot or cold beneath the stories and anecdotes. Private data helps, but it's not a substitute. Most of it is narrower, noisier, and optimized for commercial users rather than national policy. Think of it like trying to drive a truck with a bicycle speedometer. It moves, but it isn't built for the job. That means smaller surprises move bigger prices. Treasury yields jerk around on scraps. The dollar lurches on a line from a speech. Equities trade headlines instead of fundamentals because the fundamentals are temporarily invisible. Volatility isn't a bug in a blackout. It's the expected behavior when everyone is guessing the scoreboard. Who said what and why it matters. The message from top officials is remarkably consistent, even as their emphasis differs. The Chicago Fed's Austan Goolsbee has been explicit. When you're in fog, you slow down. That's not a dove turning into a hawk. It's a pilot refusing to floor it when visibility drops. The Fed's vice chair, Philip Jefferson, has framed it in classic central bank language. Proceed slowly as policy approaches neutral. That's the way a risk manager talks when the costs of a mistake are rising and the benefits of rushing aren't. Chair Jerome. Powell's tone recently has reinforced the same idea. After cutting rates off their peak, don't assume there's a straight line to lower. Without a clear view of inflation and labor, the next steps depend on what comes into focus. Different voices, same theme, caution rooted in humility, not fear. Prudence. How we got here. The mechanics of a data outage. To understand the stakes, it helps to recall what the monthly rhythm normally looks like. Payrolls and the unemployment rate set the tone for growth and slack. CPI and PPI shape the inflation narrative. Retail sales and personal spending corroborate or challenge it. Housing prints tell you the rate-sensitive sector's health. ISM and PMI surveys give you a timelier read on momentum. Then revisions rewrite the first draft of history into something closer to truth. In a blackout, that cadence breaks. We get piecemeal signals. A private payrolls estimate here, a card spending index there, a used car auction series whispering about goods inflation, an apartment listing site pointing one way on rents while a grocer points the other on food. Each of those is a puzzle piece. The Fed normally waits to see the full picture before it moves the lever. Right now, the picture looks like static. Jobs and wages without the scoreboard. Was the labor market cooling from hot to warm, or from warm to lukewarm? Without the official report, no one knows with confidence. We do know the direction of travel had been slowing, job gains moderating, openings drifting down, quits easing, and wage growth coming off its highs. But we don't know the speed. In an economy this large, speed matters. A glide down is different from a stall. If the job engine is easing gently, patience is smart. If it's coughing, waiting too long gets expensive. And while private payrolls providers and hiring platforms offer clues, they miss large parts of the economy. Their sampling frames tilt towards certain employers, certain industries, or certain geographies. They can be excellent early indicators. They are not a replacement for an official count. Inflation in the fog. Inflation is notoriously hard to read even with perfect data. In a blackout, it becomes a hall of mirrors. Some high-frequency series whisper that rent disinflation is still grinding through the pipeline. Others hint at renewed pressure in services. A few goods categories look calm. Others, autos, energy-adjacent, travel, can throw off heat in bursts. Without the official prints and the internal detail that lets you decompose the basket, you risk mistaking a blip for a trend or, worse, missing the inflection point because a private index didn't cover the segment that moved. That's why go slow has become a mantra. If the road might be turning, you hold speed until you can actually see the curve. Rates, mortgages, and your wallet. What does all this mean for the interest rates people care about? Start with the policy rate. The bar for rapid cuts rises when you can't see the economy clearly. That doesn't mean cuts are off the table. It means you want more confirmation that you're not easing into a reacceleration. Translate that to the bond market, and you get a messy path lower for yields instead of a smooth one. Mortgage rates, which are tethered to where investors think yields will be in the future, fall more slowly in that world. Credit conditions tighten at the margin because banks price in uncertainty the only way they know how, by charging a little more for risk. If you were waiting to refinance, relief still exists, but the timeline stretches. If you're a business with a line of credit, your banker becomes a little more inquisitive, your covenants a little more relevant, and your optionality a little more expensive. How markets behave without data. In a data drought, speeches become data. A single adjective from a Fed official does the work a report normally does. You'll see intraday reversals that would look ridiculous in calmer times because the marginal buyer is trading tone, not tables. The front end of the yield curve lives on expectations. The long end lives on conviction about growth and inflation. When visibility is low, both ends wobble for different reasons. Equities become a barometer for confidence rather than cash flows. Defensives hold up when fog rolls in. Cyclicals regain their footing when anything, clarifies the path. The dollar flips back and forth as relative uncertainty shifts across regions. This isn't a malfunction. It's a market coping with missing information by pricing the words that replace it. Corporate America's view. If you sit in a CFO chair during a blackout, your job is to buy time and reduce unpriced risk. You stretch maturities where you can and preserve dry powder where you must. You ask procurement to split orders and your logistics team to build a buffer into critical supply lines. You avoid big, irreversible bets unless they're so attractive that the uncertainty discount is already in the price. You talk to your board about the difference between a pause and a pivot. And you remind your operating teams that the worst decisions often happen when people confuse speed with decisiveness. A clean funding deal that restores the scoreboard lets you redeploy capital next quarter. Until then, you aim to survive this one with options intact. Small business and the household economy. For small firms, the blackout shows up in subtle but important ways. A local lender suddenly wants more documentation for a small expansion loan. A supplier asks for a partial prepayment because their own financing got tighter. Your customers, households, hear about uncertainty and delay a purchase for a month. None of those stories make a headline, but together they bend a quarter's revenue curve just enough to matter. Households feel it through mortgages and car loans, but also in small ways. Airline fares that don't fall as fast as you hoped, utilities that are slower to roll back seasonal surcharges, retailers who miss a read on demand and over- or understock in awkward categories. The household experience of a data blackout is a background hum of friction. The international layer. America isn't the only economy reacting to uncertainty, but when the world's benchmark data goes dim, global portfolios shuffle. A fragile Europe becomes more sensitive to U.S. tone. Emerging markets swing as the dollar's path looks less predictable. Energy markets watch the same fog because demand forecasts and inventory paths blur when the U.S. cannot measure itself. In that sense, a U.S. data outage is an export. It ships uncertainty across borders, and the invoice gets paid in volatility. 3 scenarios for the next 14 days. Let's sketch where this can go in the near term. The base case is that the blackout persists for now, and the Fed keeps the option to cut later while emphasizing that progress depends on clarity. Guidance grows more conditional, not more dovish. Markets chop sideways while waiting for something definitive. Mortgage rates edge lower only if recession fears start to dominate the narrative. The upside case is straightforward. A funding bridge lands, the statistical agencies flip the lights back on, and the next wave of prints shows a gentle cooling in labor and inflation. That combination gives the Fed confidence to continue gradual easing. Yields drift down, mortgage rates follow with a lag, risk assets firm as visibility returns. The downside case is the nightmare for planners. No deal, private inflation proxies flash hot, sentiment sours, and corporate guidance turns cautious. The Fed leans more conservative. Yields stay sticky at the front end, credit spreads widen, and housing relief stalls into the holidays. None of these paths are destiny. Each is a probability that shifts with the headlines and the handful of hard numbers we still get. What to watch instead of the missing reports? In a blackout, you build a composite from what's left. Watch the tone of Fed speakers. The verbs matter. Proceed slowly is different from we can continue. Look at private high-frequency signals not as truth, but as tripwires, card spending for services momentum, rent indices for shelter disinflation, used car auctions for goods pricing, freight rates for goods flow. Scan earnings calls for mentions of labor costs and inventories. They quietly replace a missing PPI table. Track mortgage applications and refi waves. Behavior often leads official statistics when households feel a turn before anyone measures it. And any credible funding timeline even before. Signatures tightens the distribution of market outcomes immediately because planners trade the calendar as much as the data. Why go slow is the right. Policy under uncertainty. Good policy under uncertainty is less about brilliance and more about discipline. When a loss function is asymmetric, when easing too much risks reigniting inflation, but tightening too much risks an unnecessary downturn, the safest path is the one that preserves options. Proceed slowly does exactly that. It keeps the Fed from locking itself into a path that might be wrong in either direction. It buys time for the scoreboard to come back. It respects the reality that inflation psychology takes years to build and seconds to panic. And it acknowledges that a single misstep can force a larger correction later. Boring policy, in other words, is a feature, not a bug, when the lights are off. How this ends, and what lingers. Data blackouts end with funding, not with speeches. When the government reopens fully and the agencies catch up, we will get a rush of releases and revisions that repaint the last month with more honest colors. Markets tend to overreact into that flood, and then settle as the new baseline replaces the guesswork. But the long tail remains. Missed training windows in the public sector, delayed upgrades in data systems, a little less trust in the system's ability to keep the lights on. The American economy is resilient. but resilience is a muscle. If you leave it underfed, it weakens at the edges first, where you can't see it until you need it. Practical playbook for households. If you're a household making decisions in the fog, here's the simple rule. Avoid irreversible moves unless the price is great. Lock a mortgage if it meets your budget and risk tolerance, not because someone on TV says a half point might be coming. If you carry credit card balances, prioritize paying them down while rates are still high. Uncertainty rarely brings cheaper revolving credit. If you're planning a big purchase, comparison shop longer and look for flexibility on delivery and returns. Retailers make mistakes in both directions when they can't read demand. And if you have the luxury, build a small cash buffer. Volatility tends to hit life at the worst time. Practical playbook for businesses. For businesses, treat this like weather. Shorten your planning horizon without losing your strategy. Split critical orders across suppliers and modes. Don't let a single hiccup hold your quarter hostage. Revisit pricing power carefully. Customers are sensitive but not immobile. And a small, well-framed adjustment can keep margins intact without destroying goodwill. Keep your debt maturities laddered. Don't let a single week's bond market wobble define 5 years of cash flow. Communicate with your lenders and investors before they call you. Credibility compounds in both directions. What Frostline will watch in real time. We're going to track a handful of signals that matter more than the noise. The verbs in Fed speeches, the shape of the 2 to 5 year Treasury curve, the spread between owner's equivalent rent proxies and asking rent indices, weekly mortgage applications and refi shares, forward freight and parcel rates, and the gap between defensive and cyclical equity baskets. We'll also watch how quickly statistical agencies can clear the backlog once funding returns, because the speed of that catch-up tells you a lot about how much lasting damage the outage did to the system's ability to measure itself. Frostline economics take. The American economy can handle bad news. What it cannot handle is no news. A data blackout doesn't just raise uncertainty, it taxes credibility. When the scoreboard goes dark, everyone plays more timidly or more recklessly, often both at once. That's an expensive way to run a country. The cleanest fix is the simplest. Restore the scoreboard and let policy work with facts instead of shadows. Until then, the right stance is steady hands and small steps. Don't chase the market into every rumor. Don't assume that yesterday's trend survived today's fog. Respect the asymmetry of mistakes and preserve your options. If this helped you cut through the fog, do us and the algorithm a favor. Subscribe to Frostline Economics and drop a like so more people see it before they make expensive decisions. Tell us in the comments how you're feeling this in your world. Your mortgage quote, your hiring plan, your inventory call, and we'll keep translating policy shocks into real-world moves you can actually use. We'll be back as soon as the scoreboard lights up, or sooner if the story turns again.